All businesses have at least one bank account, and some companies have a significantly larger number of bank accounts. Why do you need more than one account? Many businesses have a bank account for customer funds, one for outgoing payments, and one for payroll. In addition, there is perhaps a need for a bank that can handle international transfers or foreign currency, and not all banks offer those services. Whether the business has one bank account or more than one, the business needs to make sure that the activity in the company's accounting records agrees with the bank account, and if there are any variances, they need to be resolved. In this video, I will teach you about the process of the bank reconciliation and what steps accountants take to reconcile the business bank accounts. Once a month, the bank sends a statement of the deposits received, checks paid, and electronic transactions for each account. Let's take a little closer look at this bank account for Max Out Sporting Goods. The bank statement was issued by First Texas National Bank and shows Max Out as the customer, as well as the account number 3814988867. We can see that the statement is for the month of January, and it shows the balance as of January 1st of $12,025.50, deposits and credits of $37,672, and withdrawals and debits of $25,189, followed by the ending balance of $24,508.50. The activity below shows us the same information again, but now there are details for the deposits and withdrawals by date. Most companies check their account activity daily to see the incoming and outgoing electronic payments. Why? It's important to post activity timely in the accounting ledger. Some customers might prepay an order with a wire payment, and the invoice and the shipment of goods can't be completed until the money is received from the customer and posted. It wouldn't be good if the company waited until the bank statement is received to do so. In addition, accountants want to make sure that they spot unauthorized or erroneous activity quickly. Why does the company need a bank statement if all information is available online? It is the official statement that confirms the company's bank balance. Auditors will specifically request bank confirmations from the bank and will want to see the bank statement and reconciliation for the interim and year-end audits. Many accounting programs allow companies to interface the bank activity from the bank to the accounting software and typically offer assistance in reconciling the bank accounts. That said, there are still many companies that manually reconcile the bank accounts or have very complicated bank account reconciliations that need the accountant to complete the reconciliation. Here we have the side-by-side view of both the general ledger account cash as well as the bank statement. Let's compare the two and see what we find. First, there's the book balance for the cash account as of January 31st with a balance of $16,060.70. But the bank balance is $24,508.50. So why is the bank and book balance not the same amount? Sometimes the difference between the bank balance and the book balance is due to errors. The bank might make a mathematical error, give credit to the wrong depositor, or charge a check against the wrong account. Other than errors, there are 4 reasons why the book balance of cash may not agree with the balance on the bank statement. Outstanding checks, which is the term we use when we have checks that have been issued and recorded in the company's general journal, but have not yet been cashed by the bank. For example, the company issues 5 checks on the last date of the month, but the checks aren't cashed until the following week. Deposits in transit include deposits that have been recorded in the company's general journal, but are not yet reflected on the bank statement. For instance, a deposit is made on the last day of the month, but the bank doesn't post it until the next day. The third reason for a difference could be service charges and other deductions, meaning, for instance, that the bank charged a service fee or a fee for return checks called NSF checks. The fourth reason for a difference between bank and book balance could be deposits that are on the bank statement but not yet recorded in the business records. So how do you figure out what is missing from either the bank statement, which is called timing because it appears on the next bank statement, or hasn't yet posted by the company in its general ledger? Let's look at that next. One of the advantages of this reconciliation is that the beginning balance on the company's books equals the beginning balance of the bank statement. Both are $12,025.50. That means we don't have to go back to the prior bank reconciliation to see if there's still some open items, which means that we only have to find the variances for January. First, we'll look at the deposits for January on the bank statement. It shows $37,672 for all January deposits, but the book deposits is $42,612, a difference of $4,940. I see that there is a deposit of $5,940 that was recorded on January 31st in the company ledgers, but I don't see that amount on the bank statement. So the amount of $5,940 will likely be on the next bank statement. In the meantime, we will have to list that amount as a deposit in transit on our reconciliation. But now we still have a difference of $1,000 because the difference between the bank deposits and the book deposits was $4,940, but we identified $5,940. Scanning the deposits for $1,000, I see the January 31st deposit on the bank statement that hasn't been recorded in the company's ledgers because I don't see a book deposit for $1,000. After doing a little research, we discovered that the bank gave Max Out Sporting Goods a loan of $1,000. Since it hasn't been recorded yet in the company's ledger, Max Out needs to record that transaction. Now let's look at the withdrawals and figure out the variances. What I've done here is put a check mark next to each item that was the same on both the general ledger and the bank account, bank statement. For instance, the first check of $111 is shown as $1,500 in the general ledger and the bank balance. After going through all of the activity, I can see that the company issued checks 124, 125, 126, 127, 128, 129, and 130, but they're not yet listed on the bank statement. Do you recall the term we used for that? It's called outstanding checks. They will likely appear on the next bank statement. On the bank statement, we have three items that I could not find on the general ledger report. The first item is $1,600 and appeared on January 22nd and is listed as check 10087. That appears to be a check that belongs to someone else. It doesn't agree with the numbering that Max Out Sporting Goods uses for its checks. So we have to talk to the bank about it and would expect the bank to correct that error. The next two items are for $525 for a customer check that bounced that hasn't yet been recorded, and a service fee of $25 that also hasn't yet been recorded. So now we're at the point that we can start our bank reconciliation. Let's start with step one when we enter the ending bank balance of $24,508.50 into the top section and the ending general ledger balance for the bank account into the bottom section. Step two is when we enter the additions to the bank statement. These are either errors that the bank made, like when they charged the check 10087 to Max Out, but it wasn't a check that Max Out had issued. we would expect to get the money back. In addition to such error, we also enter the deposits in transit here. We expect to have the bank show that deposit on the next bank statement. And that's what you see here, the amount of $5,940 for the deposit in transit and the error of for $1,600. In step 3, we enter the outstanding checks, which the bank will deduct from the bank account when they clear next month. So that's what you see here, checks 124 to check 130 for a total of $15,537.80, which we deduct from the bank balance. When we take the beginning balance of $24,508.50, add the additions of $7,540 and subtract the outstanding checks of $15,537.80, we arrive at the adjusted bank balance of $16,510.70. In step 4, we move to the adjustments needed to the book balance and enter any deposits that were on the bank statement but have not yet been recorded in the company's ledger. Here we have the deposit of $1,000, which MaxOut received from the bank. In step 5, we enter any unrecorded deductions, which means these are amounts that the bank correctly deducted from our bank account, but these amounts were not recorded and posted in the general ledger. So that's what I did here. I entered the NSF check for $525 and the bank service charges for $25 and calculated the balance in books of $16,510.70. This amount must agree to the adjusted bank balance, or you will have to continue looking for the variance. A very important reminder, all amounts that we adjusted the book balance for, meaning the bank loan, the NSF checks, the bank service charges, must be recorded in the general ledger for the month of January, which is our step 6. In our final step, we now record the adjustments that we just talked about in the general journal. By debiting the accounts receivable account for David Newhouse for $525 and debiting the bank fees expense account for $25 and crediting the cash account for $550. The next general journal is for the bank loan received from First Texas National Bank for $1,000, which will record as a debit to cash, and a credit to notes payable for $1,000. Once these general journals are posted, our general ledger account for cash should show the balance from the bank reconciliation of $16,510.70, which it does. That brings us to the end of the process of preparing a bank reconciliation until next month, when we'll have to prepare another bank reconciliation. Hope you enjoyed the video and learning about preparing bank reconciliations.